All right, welcome. Today we're going to try and decode the language of the financial markets by diving into something called technical analysis. It's a fascinating world that's part science, part art, and it gives us this really powerful visual way to understand what's really going on. So let's just jump right in. So let's start with a really big question. What actually drives the world's financial markets? I mean, is it complex algorithms? Is it breaking news headlines? Corporate profits? Well, the answer, according to the sources we're looking at today, is actually a lot more human.
Yup, it all pretty much boils down to two basic human instincts: fear and the desire for profit, what a lot of people would just call greed. These primal emotions, they shape our behavior, and as we're about to see, they're like the invisible hands that create the patterns that technical analysts spend all their time studying.
So let's really dig into that first part, the drive for profit. It's so easy to think of it as this modern Wall Street kind of thing, right? But the material we're drawing from frames it as something way deeper, a core part of what makes us human. See, to really get it, you gotta go way back to our core evolutionary instincts. It's pretty well accepted that we're all born with three main drives: the instinct to survive, the need for comfort, and of course, the instinct to propagate. And out of those three, survival is without a doubt the big one. It's the king. Everything else comes second. And this is exactly where the hunt for profit comes into the picture. It's not just about getting rich. It's basically the modern version of our ancient need to find food and shelter, to secure the resources we need to survive. Okay, so if making a profit is basically a survival thing, how do you actually do it in the markets? That brings us to the actual mechanics of trading and how people try to make money from all the constant change. When you strip it all down, making money from market changes really just comes down to two super simple actions. You either buy something when its price is low and sell it when it's higher, or you do the exact opposite. Let's break down what those two strategies are actually called. All right, so the first one is probably what you already think of when you think about investing. It's what traders call going long. This is the classic strategy. You buy an asset, you hope its value goes up, and then you sell it for a profit. The whole thing is fueled by demand. The more people want to buy, the higher the price tends to go. Now, the second way. This one's a little weird if you've never heard of it before, is called going short. This is where you're actually betting that a price is going to fall. What you do is you borrow an asset and sell it at its current high price. Then, if you're right and the price drops, you buy it back at the new, cheaper price, return it, and you get to keep the difference. This side of the market is driven by supply. More people selling pushes the price down. Buy low, sell high. Sell high, buy back low. I mean, come on, that sounds ridiculously simple, right? If it were that easy, we'd all be retired on a beach somewhere. And that leads us to the real billion-dollar question. Maybe even trillion-dollar question. It's all about the timing. I absolutely love this quote from our source material because it just nails it. The mechanics, the buying and selling, that's the easy part. It's the timing. That's what's critical. When do you buy? When do you sell? That's the whole game. So yeah, here's the real kicker. The thing that makes this so hard. You have to predict the future. You have to figure out where the price is going to go before it happens, so you know when to make your move. And that, as you can imagine, is a massive challenge. So how on earth do traders and analysts even begin to try and do that? Well, they start with a really fundamental tool, the price time chart. It's just a simple two-dimensional graph. On the vertical, or y-axis, you've got price, and across the horizontal, or x-axis, you've got time. This simple chart is the canvas where all technical analysis happens. And this is where technical analysis finally enters the picture. It's this whole world of tools and ideas, all designed to solve that one massive problem of timing by looking at these charts. But what's interesting is that analysis isn't just one thing. It really has two very different faces. Yeah, the best way to think about it is that technical analysis kind of has two personalities. On one hand, it's a historian. It identifies and describes what's already happened in the market. It's just a historical record of facts. But on the other hand, and this is where it gets a little controversial, it's also a fortune teller. It tries to use all that past information to predict what might happen next. So let's talk about the historian role first. This part is purely about the facts. It's the science part of the equation. By looking at a chart, anybody can see exactly how a market performed over time, how volatile it's been. You can see the historical highs and lows. You can even see how the market reacted to big news events. It's all just objective, verifiable data from the past.
Okay, now for the fortune teller. This is where things get a little more, well, a little more interesting and a lot more debatable. This whole forecasting side is built on one giant assumption that price patterns repeat themselves. The core belief here is that because human behavior, that fear and greed we talked about, is consistent over time, then the chart patterns that behavior creates should also repeat. This is where the art comes in, interpreting those patterns.
And this brings us right back to the ultimate question. If technical analysis is part hard historical fact, but also part subjective interpretation, where does that leave us? Is analyzing markets a rigid objective science that's all about data? Or is it really more of a subjective art that relies completely on the skill and maybe even the intuition of the person looking at the chart? Something to think about.